Good morning, traders. It is Friday, March the 13th. Taking a look at the charts, we're going to start off with the indexes. We haven't covered them all in quite a while. Let's start off with the worst and work our way to the best. Now, the worst performing here going forward is the Russell 2000. So the small cap stocks. It's down almost 38% to the low this morning, actually. It poked down to some new lows this morning, and now we're starting to see a nice rebound. Most indexes are up 5+% this morning, so we are starting to see an oversold reaction bounce. And this could be a significant one. Yesterday seemed to be one of those big washout type of lows where we had some more bad news that really kind of hit the market hard. Hopefully that was the bottom, or this morning was the bottom, and we're starting to see a rally. But overall, down 38%, the small caps. You can see here these three significant lows were clearly broken, and it came all the way down and broke this low from 2018, and we're way below that level. So that's the worst performing sector. Small caps, they're amazing when you catch them on the right side. They have the biggest rallies in bull markets, but they also have the biggest pullbacks in bear markets. So it's a double-edged blade. You got to know how to trade them and have position management in place. Now, the next performing asset, the next worst, is the bonds, the Dow Jones. You can see we broke this significant low, and we also broke this significant low yesterday. Yesterday, the market closed below it. Overnight trading and pre-market this morning, the market crashed some more, and then big buying has stepped in, and prices are driving back up, which looks like maybe this could be a reversal type of day. This is a really significant level. I got a feeling we're going to see some Hail Mary moves where, who knows, the Fed or government, whatever, steps in and is potentially just buying the market up, and they're just doing their thing to try and save the market. I have a feeling we've reached that level that they're going to step in, whether we know it or not, and try to support prices. Now, the next index is actually SP 500. The SP 500 came and broke this significant low. Now, we didn't break this low from 2018. We got darn close to it in pre-market this morning. It's down still 30% from the high only 3 weeks ago. And more or less, it's having a big rebound today, moving up. Of course, we flushed this low out and got close to this. I think, again, it is at a point here where the last time we got down to this level, we saw a V-shaped recovery. So big sell-off, big rally, and then took off. So I have a feeling we might start to see something like that again. This is a level where we saw big money step back in and buy, and it could be another opportunity to the upside. The best performing index is actually the Nasdaq. Of course, it was leading the way really for the whole bull market. And you can see here, it came down and it only tagged this low in pre-market trading this morning. Came all the way down, touched this level, and now we're seeing a sharp bounce. Where all the other indexes broke this and broke this, SP 500 came down to test this one. The Nasdaq is still holding up. Now, it's still down 29%, but it hasn't broken as many significant lows. It's only broken 1, 2, 3 lows, and then it's tested this more significant pivot low on the chart, and it's bouncing off it. So out of all the indexes, the Nasdaq is actually the top performing in terms of the best chart pattern, the most bullish case going forward. Okay, so let's take a look over at safe havens this morning. Bonds are down about 1%. They were down huge this morning. Big unwinding of bonds. They're starting to bounce back up in pre-market here. Overall, again, it's going to be another wild day. Who knows? We're up 5% now. For all we know, it could be down 5% by the end of the day. We'll see what kind of panic kicks in, whether it's short covering, panic buying into the close. We see the market close extremely strong on the day, potentially up 5 or 10%, or we see panic selling. No one wants to hold positions, and they just cash out all their positions going into the final hour, and we see a huge drop and close near the lows. Who knows what we're going to see? This is one of the reasons why we are in cash for short-term trading. We are in this parabolic where price can go straight up and straight down and go back and forth like a yo-yo. Really without a whole lot of insight, and really you're better to watch than to ride it out. And at this point, bonds were down significantly. They've rallied back, which is a little nerve-wracking because if big money is starting to pile into bonds here in the early morning, that means they might think that there's going to be another big bout of short selling and dumping positions in equities. So we'll see how things unfold. But overall, bonds are still kind of in this corrective phase where it had its blow off top. I think we're going to see bonds trade a lot like what gold is. I'll cover gold in a minute, but more or less bonds are going to be in this big range here and potentially cone out, cause a pennant formation, but bonds could trade in this range for quite a while and potentially flag downward going forward and catch a lot of people off guard. So let's go take a look over at precious metals. Here is the chart of gold, and you can see gold got all the way up here, got close to the 1700 resistance area, which is more or less it was a measured move. Came all the way up, hit this. You got this run, you got the pullback, you got the second run. It pulled back significantly, and then we had some big selling in the stock market, and gold started to perform really well, but big sellers stepped back in and have crushed the price. And if we were to go way back in time, let's go to the weekly chart. Here's the weekly chart. You go back to 2011, 2012 top. If you go through the noise from the extreme high down to the extreme low, draw a line through the middle of it, more or less there's a lot of little bars that actually start and stop at this red line or go through it. And that is the 1700 mark. It's a whole number. Naturally, people will say, hey, if it rallies to 1700, I'm going to take some profits. If it rallies to 1800, I'm going to take some profits. More or less, when you hit a whole number, it's always going to have a little bit of resistance. But this resistance is very significant. There's pivot high, lots of bars that traded through there. It's right in the middle of the high-low range from 2011, 2012, which means that's where there's going to be the average price traded. And all those people that have been underwater for, 8 years are going to say, hey, get me out. I want my money back. I'm going to find some new asset class. So that creates even more resistance on top of the whole number, the 1700. So we've got some big volatility. You zoom into the price range. I think we could see this go into a pennant formation or potentially correct back even further. Now, if you look at the price action, we're in this big stage 1 basing formation, this yellow box, which it's hard to see, but this yellow area is the stage 1 basing formation. And we broke out of that, and this is what we called, and we traded this, and now we're in this bull market. Let me get a different color, actually. Now we are in this bull market for gold. Gold is the only one here out of gold, silver, and miners that are in a bull market. So we're in a bull market. It's rallied all the way up. And now we're probably going to be trading in this resistance area. Could be ping-ponging around sideways. It may even flag to the downside and come back down to the 1500. We're going to have volume through the heart of this, this whole consolidation, which is the 1500 whole number. So it could pull back, bounce, and get back to that area. Overall, this is a very significant line in the sand that it's tagging in. There's obviously clear resistance with the selling that's been going on. So overall, in a perfect world, what we would see is gold, miners, silver continue to consolidate or flag downward, which is still bullish price action, at least for gold, actually. As long as it flags sideways, eventually when the stock market starts to roll over, well, it already has rolled over, but I mean, when we go into a real full-out bear market where we see the equities markets bounce for a few months and then they start to roll over and start the first real leg to the downside, because if this is the start of the bear market, there's going to be a lot more downside potential than what we've seen so far, 2 or 3 times what we're already down. As the market bounces, the stock market bounces, gold, silver, miners will flag sideways, and then we should start to see them outperform again and start to take off, and we could see potentially a big run in metals and miners later. But right now, they are under pressure because they're at resistance, and the stock market is on the verge of putting in a major bottom. And when stocks rally, we see the safe haven sell off. And that's what the play is for bonds as well. We caught the panic wave in bonds. It spiked up, and now bonds are selling off because big money is starting to move back into equities. Even though there's so many shares being sold, the big money can't stop the drop, but they're accumulating and they're not going into bonds. So eventually we're going to see a knee-jerk reaction rally in equities themselves. Now let's take a look over at silver. It's down 1.25% this morning. Again, silver is still in this stage 1 base. It has not broken out of this level yet. It continues to trade sideways. And more or less, the short-term pattern is still bullish. We've got the run up. We've got an A, B, C correction. The C correction breaking this little low over here is what cleanses the market, shakes things out, and that's usually when we see things start to go higher. So this could be a good shakeout. We're getting down into a support zone through here, right across this level here. And hopefully we'll see it find some traction and continue to work itself out. Eventually we're going to be looking for it to break out of this base. This significant high is very important. And once we break that, then we should be off to the races and we can see silver really go parabolic. But you can see it's still a long ways away from there. 15 an ounce, it needs to get to 21 and break it and hold it. So it's still, percentage-wise, it's still 33% away from breaking out of a base. Looking over at gold miners, here is GDX, which are the large caps. You can see this upper resistance area from these previous highs. This is a stage 1 basing formation. I've talked about this many times. Gold broke out. Gold miners have not broken out. We started to get a fake out here. We actually got our target and a short signal to get out of miners on this fake out in the juniors. We got out literally at the high tick of the day, and from there we've seen them sell off. Gold miners are down, I think they're down 40% since the high that we got out. But this is the large caps, GDXJ. You can see the damage being done. I'm not a fan of these big shakeouts, these fake outs. It means there's manipulation going on. The big money's kind of working things out, but more or less we've got broadening formation, which means price could chop around and do whatever it wants. We want to see something nice and clean, a nice clean tight formation and a potential move, but at this point it's a broadening formation, huge volume selling, so nothing too significant or exciting there in terms of us getting ready for a breakout. This has really negated it. It's going to take some time to work itself back up. Looking at the GDXJ, GDXJ didn't get to the breakout zone. It underperformed, and you can see here it's moving down very significantly, huge volume. It's still in the stage 1 base, and we've got a similar broadening formation. We've got this low and this low. We've got higher and high, so huge broadening formation. Overall, I think most of the damage is done to the downside. We broke this level, so we might see some follow through, panic selling over the next couple of days, just kind of wash out low. But it looks like the stops got run, and the dumping, it was really margin calls. We saw metals and miners just get their clocks clean with margin calls, forced selling, and it happened over here on this big red bar day. And of course, this day was even bigger, and the bigger it gets, the more margin calls that get triggered, and it creates this giant downspout going forward. But overall, gold miners still in this stage 1 basing formation. They were starting to look pretty exciting, but totally rejected it, and we're nowhere close again for gold miners breaking out. Taking a look over at energies. Natural gas up 3%. It's all over the place this morning. It was up 5-6% a few minutes ago. This is the weekly chart. I'm going back to the daily. Here is the daily chart. Gold miner's been in this steady stream selling down. It looks like it's starting to build a base. We finally have this some volatility, and that is showing that we're in a high volatility potential turning point. We've tested the 20-day, we came back down, new lows, tested the 20-day, and now we're flirting with this 20-day. So we've got this nice pop, a little bit of a pullback. It looks like that momentum is shifting, and potentially it could start to run and break and take a run to this 240, 255 area going forward. We'll see how things unfold, but it's starting to look bullish on the charts. Looking at crude oil, up 5.5% this morning. Again, it's still in this range. We've seen it break these levels, continue to break down, and at this point, it still looks really bearish. I mean, it's oversold, but that's what happens. That's in a downtrend. The market's always going to more or less be oversold. In a bull market, it's almost always overbought, and that's why it's tough to sell short, because it's so oversold. You're ready for a knee-jerk reaction. In a bull market, it's so hard to buy because it's always pushing new highs and it's always overbought, and you're waiting for that pullback. That's just the way the market works. This chart still looks really bearish. I mean, if we were to throw a Fibonacci extension on here, let's just squish the chart down and just get the most conservative outlook. If we go from this bar down to there and back up to here, carry it forward, we would be looking for energy for oil here to bounce to this level. This 17 downside. This pattern here has got a lot of energy, huge power into it. It's in this tight little range, and 17 on crude could be next. More or less, we're trading inside bars here. If you look at this price action, let me just scale this in. We're pretty much in inside bars, meaning this big down day from the high down to the low and carry that forward. You can see we're trading within this range. Inside bars are very, in this case, they are bearish. If the move was down going into this bar, all these inside bars are just building up power for the next similar bar. Whatever this height was, that bar will be the same. That'll bring us down to that 1750 area, whatever that target was. So overall, crude's still really bearish. It's on the verge of another big drop to the downside. Last but not least, let's take a quick look over utilities. Here's the utility index. It was an outperforming sector, and now it is definitely underperforming. Yesterday, a huge bloodbath in utilities. It opened sharply lower and sold off and just kept on going. Overall, this is a big ABC correction. You've got an A, B, C. They are usually very bullish in terms of we should get a strong bounce back up, at least to this low area and this close. This is going to act as a natural resistance zone right across here. So we could see a strong bounce. But overall, what's interesting is the stock market is moving lower. Bonds are falling, and utilities, which are seen as a safe haven, are falling as well. And if money is moving out of the safe havens, that means it's going somewhere, which means they're accumulating equities or they're moving to cash. And if they are moving into equities, once the panic selling from the masses, that huge flood of volume of sell orders starts to dissipate, all this money moving out of these safe havens, gold, utilities, is going to take over, and it's going to drive the stock market back up. And so that's what's going forward here. I think the play for safe havens are now kind of, they're fizzled out. They had the nice move. We caught the nice move, and now they're actually underperforming. And now we're looking for more or less a risk on play, which means we're going to see a bounce in equities, and we should start to see, hopefully have a new setup to the upside and see some follow through going forward. Anyways, super long video this morning. Sorry about that, but I'll talk to you soon, and take care. Bye-bye.